Welcome students to another video. We're going to be focusing on investment management. We're looking at support material 5. When we're looking at support material 5, we're looking specifically at the analysis of fixed interest securities. So if we're looking at fixed interest securities, remember that we need to understand some basic fundamentals of the analysis in order to analyze these fixed interest securities. So just remember, a fixed interest security is basically something like a bond, which provides us with a certain amount of interest or a payment that's going to be received over a period of time. So when you're looking at fixed interest securities, you could be looking at something like a government bond, you could be looking at corporate bonds, you could be looking at any assets that's going to be paying a certain amount of interest in the form of maybe like a coupon payment that's going to be payable to the investor over a period of time. So when we're looking specifically at this section, which is looking at fixed interest securities, the most common fixed interest security that you're going to be getting as a investment asset class is bonds. What is a bond? Well, a bond would be a fixed interest security that's going to be paying us a series of fixed income payments over a period of time. So if you're thinking about something like a loan, if you give out a loan, that loan is going to be repaid by the person taking out the loan over a period of time. So if you're giving out loans, obviously those loans that you are giving out would be seen as an asset because you're going to be generating some sort of return on investment when those loans are being paid to you. So if we're looking at a bond, just remember that you are going to be considered the bond holder. Remember, in investment management, we're looking at making decisions today that's going to give us future benefit in the future. So when we're looking at bond holders, we're looking at the investor's point of view. We're going to be buying these bonds, and in return, we're going to be receiving a series of fixed income payments over a period of time. And that's what we call is the coupon, basically. So just remember, in this section, you get different types of bonds. The Bond Exchange of South Africa has government bonds, municipal bonds, corporate bonds that you can make use of as a potential investment. Just remember, if you're looking at bond pricing or valuation, we're going to be using simple time value of money principles, and we're going to be determining the present value of those bonds over a period of time. So if we're looking specifically at the risk that's inherent in different types of bonds, there's a lot of different factors to consider. Some of them are as follows: interest rate risk, price risk, reinvestment risk, credit risk, default risk. There's a lot of different risks that need to be taken into consideration when doing bond calculations. Fortunately, in this particular module, you don't have to go too deep in terms of risk exposure and what bonds would be subject to in terms of their risk and how prices will be affected in that particular scenario. Just keep it simple. Remember, bonds are investment asset classes that can be used to generate some sort of return on investment. When looking at the content in your textbook, they talk about different rating agencies and they classify bonds according to these different measures. So the first question about whether bonds are created equal or not, the answer is definitely not. Right? All bonds are not created equal because you get different types of bonds and you get different ratings for these different types of bonds. So how do we determine the quality of a bond? Well, if you've ever heard of these rating agencies, Moody's, Standard & Poor's, and Fitch, those rating agencies basically establish a measure for a particular bond based on various risk factors. For example, you might be looking at bonds in certain countries. For example, you could have bonds in a country like Russia, and then you could have bonds in a country like South Africa, or you could have bonds in a country like America. These rating agencies would be valuing these bonds based on various factors. Right, so the quality of the bond would be based on maybe the geographical location, maybe whether there's a war or no war, whether the country is stable or unstable. It all depends on these various factors. So these rating agencies, they classify these bonds according to these rating, these measures, okay, these ratings that we can obviously see. For example, AAA rating, investment grade rating, it could be triple B or B minus, where you have sub-investment grade bonds, or you could even have junk status. Okay, so bonds that are considered very, very high risk, and there are different ratings for those. All right, so just remember, when you're looking at theory, bonds can be rated by these rating agencies according to different classifications. There's many different types of bonds. Just to list a few here: zero coupon bonds, which don't pay out any interest. You get coupon bonds, which pay out interest over a period of time. So when we're looking at coupon bonds, you're looking at those payments, the PMT, when doing time value of money calculations. You do get many other types of bonds that have different embedded options: callable bonds, puttable bonds, convertible bonds, extendable bonds, retractable bonds, and exchangeable bonds. All of those bonds have different characteristics, and those characteristics would determine how valuable a particular bond is in terms of being an investment. Remember, businesses want to invest in bonds that potentially have these options that can help us as an investor, depending on what sort of options we have on those bonds, okay, those assets that we've invested in. Right, so let's keep it simple. Let's move towards your time value of money calculations. When doing a bond calculation, you need to remember this context. Just remember, a bond is a security that requires the specific payment to be made to the bondholder. It's basically an IOU arrangement. Okay, so you're buying these bonds, and those bonds are going to be providing you with a certain amount of interest in the form of a coupon payment every period. So when we're looking at time value of money, there's something called a face value or a par value, which refers to the FV in the actual time value of money calculation, which will take place at the end of the value, or not end of the value, end of the life of the bond, which is its face value. You also get a coupon rate, which is a percentage that's used to calculate the payment, or the PMT, in a bond time value of money calculation. And then you also have a yield to maturity, and I. That yield to maturity represents the interest rate that is applicable in that time value of money calculation. Then just remember that you do get premium bonds and discount bonds. We will discuss this in more detail in a later slide. Right, just remember, a premium bond is a bond that's selling above face or par value. And then you've got a discount bond, which represents a bond that's selling below its face or par value. Then there are some measures that we'll be calculating a bit later: duration and convexity. Those two measures establish the measure of risk for a particular bond. How risky is that bond? And in order to determine the riskiness of that bond, we need to look at the duration and the convexity. And then when looking at bond value, we need to remember that bond value is literally taking all your future payments and discounting them back in time. So if I'm looking at a bond, I'm going to be focusing on those future coupons, or those payments that will be discounted back in time. I'm also going to be looking at that face value, or FV, that I'm going to be discounting back in time. So remember, bond value is literally taking all your future payments and discounting them back in time. Something else that you might be asked to calculate is the current yield. The current yield is just a measure of what you're currently going to be receiving in the form of an annual coupon, which is basically your interest payment, divided by the bond price. That gives you your current yield for that particular bond. So let's apply our simple time value of money principles, and let's use the discounting of future cash flows back in time to determine what the present value is. All right, just remember, when we're looking at bonds, which are fixed interest securities, we're going to be discounting future cash flows back in time. So when we're looking at future cash flows, remember, the face value or the par value is your FV. That FV is going to be right at the end of the life of the bond. Obviously, there'll be coupon payments. Those coupon payments will be paid over a period of time. Okay, each period you're going to be getting a coupon payment. Right, so time value of money says take all your future payments and discount them back in time. If you discount them back in time, that's going to give us the PV, which is the bond price. Something we need to consider, though, is when you're discounting future payments back in time, there's an interest rate that's going to be applicable. If that interest rate increases, well, then your PV will decrease because I'm going to be discounting using a bigger I. The bigger the interest rates, the smaller the bond price. If I have a smaller interest rate, so if the interest rates decrease, that's going to lead to a larger or bigger bond price. Right, so you've got rising interest rates or falling interest rates. There's an inverse relationship between the rate that's applicable in the markets and the current price that you need to pay for that particular bond. Right, so when we're looking at these bond fundamentals, just remember that there are various financial institutions that will be creating these financial instruments. You have these borrowers and lenders, or savers and investors, that are basically creating these financial products, which we can then choose to buy and sell as the investor. So if we're looking at what determines the level of borrowing and lending in the markets, well, there are many factors to consider. We just need to look at some of them. So obviously some sort of return is important to measure how popular or how in demand this particular investment asset class is. Nominal yield also, what is the quoted rate of return for the coupons? The current yield, what are we going to be getting compared to the bond price? And then obviously the yield to maturity is looking at the annualized IRR based on the bond's price. So lots of time value of money to consider. Earlier we spoke about the discount bond. Here you have a more summarized note regarding the two different types of bonds. If I have a discount bond, we spoke about the bond price being less than the principal value. So if we had to relate that to the coupon rate, remember bonds that pay coupons, if the coupon is less than the discount rate, that means this bond isn't very attractive. The interest or the return that you're going to be getting on this particular bond is not in line with the discount rate. It's less than. So if it's less than the discount rate, you'll have a coupon bond. If the opposite is applicable, a premium bond is when you have a bond price that's greater than the principal value. In that situation, the coupon rate will be very, very attractive. Okay, the coupons or the interest payments are going to be a lot more, greater than the discount rates, and that would lead you to a premium bond. Right, so discount bonds, premium bonds, and then you have par value bonds. And a par value bond is when the bond price is the same as the principal value. So there's no difference between the coupon rates and the discount rates. So let's take that a step further and just consider when we would want to invest in bonds. Well, time value of money principles will always apply. Then we need to think about the bond value when making a decision on whether to invest in a bond or not. So if interest rates are going to change over a period of time, those changes in terms of those rates and how it affects the time value of money principles when determining the bond value is going to decide or make us decide on whether we should invest in bonds or not. So let's think about this. What happens when interest rates rise? And what happens when interest rates fall? So if you're looking at things from an investor's point of view, if interest rates are rising, those bond prices are falling. If I'm looking at interest rates falling, then those bond prices are going to be rising. So when looking at the market, we need to determine what sort of bonds are we going to be investing in that will allow us to generate higher returns on investment. So just remember, simple time value of money principles will always apply. The yield to maturity is a rate that's applicable when looking at the investor's point of view, and the investor will earn that yield to maturity if they buy and they hold that particular bond until it matures. Just remember that bonds are inversely related to, there's inverse relationship when we're looking at the bond prices and how it relates to the interest rates. Right, just remember it's the opposite. If interest rates rise, bond prices will fall, and if interest rates fall, bond prices will rise. Just something additional that you might have seen in some of your other modules, if you've done the time value of money DSC module where they talk about bond valuations, there's a clean price and an all-in price that can also apply when determining the price of a particular bond. The clean price is just the price of the bond estimated by the market, representing the present value of all those future interest payments and the maturity value discounted to the current point in time. The all-in price is the clean price, but also adjusted for any accrued interest that might apply based on whether the coupon is paid out or not, and at what point in time will that coupon be paid out or not. All right, so those are just some basics looking at bond fundamentals. It's important that you understand those fundamentals before you look at the next section, which is looking at study unit 12, which is focusing specifically on the valuation of these fixed interest securities. Right, so let's have a look at bond valuation. These are very, very complicated maths equations, but if we keep it simple, we know that bonds are valued based on time value of money principles. So if I have an annual coupon bond, all I have here is the interest, okay, or the coupon, and this fancy mathematical equation is basically saying taking all those future payments of interest, discount them back in time. And then I'm going to add the face value or the future value, okay, the par value, and I'm going to discount that back in time. Right, so basically if you're looking at those two things, it relates to what we spoke about earlier. The bond price is literally the present value of all your coupons plus the present value of your FV, your face value or your par value. Okay, taking future value back in time, taking coupons back in time, that's going to give me the bond price. Right, so if it's annual coupons, then we're using the entire coupon. If it's semi-annual, same thing will apply. Only thing different is you're going to have divide by 2 because you're looking at half-yearly periods. But the same thing applies. You're taking future coupons and you're discounting them back in time. You're taking the FV or the par value and you're discounting them back in time to determine the bond price. Right, so all of this can be done on the calculator. All we need to do is apply simple time value of money rules, and we need to discount those future cash flows back in time using our financial calculator. So if we're looking specifically at bonds, what is the meaning of each of these variables in a bond calculation? Well, it's actually quite basic. We just need to apply them to the context of a bond, right? If I take future cash flows and I discount it back in time, the PV is going to represent the price. The FV is the par value or the face value. The PMT is a interest rate or a coupon that's going to be payable. Okay, that's the payment every single period. I would be the yield to maturity and N would be the term. Right, so just remember that when looking at time value of money calculations, all we're doing is we're taking future cash flows and we're discounting them back in time to determine what the bond price is. Something else to note that you can use when looking at the calculator is calculating your I or even your IRR. Okay, IRR is used in discounting future cash flows back in time, and I is used when looking at simple time value of money. Right, so success lies in mastering time value of money principles. If you can take future amounts and discount them back in time, you're not going to have any problems determining the present value for those particular assets, okay, bonds. Right, so remember, N is the period, I is the rate, PMT is those payments or coupons. Just remember, the blue text is highlighted for a reason. When determining your coupon payment, you need to use the coupon rate. Multiplying the coupon rate by the future value or the face value or the par value, that determines what the actual payment is. PV is the present value of the bond price. FV is the future value, which is the par or face value at maturity. Just remember that everything you do in time value of money, you need to make sure that the N, the I, and the PMT always relate. If I've got quarterly payments, then I need to use the number of quarters. I need to use the effective quarterly rate because my payments cannot be changed. Those payments are set in stone because these bonds are going to be issued as a contract. Okay, it's a promise to pay. Remember, IOU. Right, so you have a few calculations here to do. Please maybe pause the video here, try do those calculations to see if you can do the simple time value of money calculations. All right, example number 1 says company A issues a 10% 15-year annual coupon bond with a par value of R1,000,000. Determine the price of this bond using a required rate of return of 10%. All we have to do is literally identify the variables. Right, so your FE here is 1 million, your N here is 15, your I here would be 10%, and your PMT which would be calculated based on the measure in the question, the interest rate, the coupon rate, and it'll be 10% of 1 million, which is 100,000. Right, if you discount that back in time, that's going to give you an answer of 1 million. Right, so what do you notice? Well, if we look at the coupon payment, the coupon payment here was 10%, and the required rate of return was 10%. So earlier on in one of our slides, we spoke about bonds trading at par or face value. So you can see that the million rand that we calculated is the price of the bond. The price of the bond is the same as the par value. Right, on the next slide, example number 2, same thing applies. We're looking at company B. You're issuing 10% 15-year annual coupon bonds with a par value of 1 million. You're going to be determining the price of this bond using the required rate of return, which is 14%. Right, again, simple calculation. Plug in all the values. So N is 15, future value is 1 million. Your interest rate is 14%, and then your payment would be based on the actual coupon rate in the question. So your 10% times your million, which is 100,000. But if you discount that back in time and you calculate your PV, you're going to get this answer. Right, what does that represent? What do you notice? Well, you can see here that my yield to maturity is greater than my coupon payments. Right, or you can interpret it like this. Your coupon payment is less than your yield to maturity, okay, your required return. Right, so obviously this will be a discount bond. Discount bond meaning less than the face value, okay, of 1 million. Right, you have one more example here. Example number 3. You've got company C. They're issuing a 10% 15-year annual coupon bond with a par value of 1 million. Determine the price of this bond using the required rate, which is 8%. Right, same thing applies. Insert all of those values on your calculator and solve for PV. When we're looking at PV, we're determining the bond price. In this scenario, you can see that the bond is going to be paying a coupon, which is 10%, which is a lot higher than the required rate of return. So you can see that this bond will be trading at a premium. A premium because the interest that's being paid is advantageous to the bond holder, the person buying the bond. This bond is going to be paying 10% interest all the time as a coupon. And if the rate is 8% in the market, well, obviously this bond would be very, very attractive. All right, so now that we've covered all those general calculations, we need to move on and we need to focus on these spot and forward rates that can apply to bonds. This is something that the textbook does talk about from time to time. The textbook talks about these arbitrage opportunities that can exist, where we're going to be looking at these forward rates, these spot rates, and how we can consider those rates as a way to determine what the bonds are going to be. Right, so before we continue, just some 2 important definitions to describe. Stripping, which is bonds where coupons become 0 coupon bonds, and we're discounting those back in time. Spot rates is the actual current rate, okay, for those discount rates for 0 coupon bonds. Right, so here's an example looking at these rates, these forward rates and these spot rates. If I'm calculating the forward rate and I've been given the following information, an investor wants to invest 100 Rand for a 1-year period, and the following spot rates are 1 year 0 coupon bond yielding a spot rate of 10.5%. I also have a 6-month 0 coupon bond yielding a spot rate of 10.3%. After 6 months, we want to know the investor would want to reinvest for a further 6 months, and we want to know what would the rate be for this additional forward 6-month period. Right, so remember, you've got something now, okay, so current bonds today, and we're trying to predict or estimate what the current rate would be for that additional 6-month period. Right, so current spot rates is looking at what we have in the current market. We have 6 months in terms of a 0 bond, 0 coupon bond, and then we need to determine what is that difference going to be, or what is that other rate going to be. Right, so there's a formula that you can use here, taking simple time value of money principles into consideration. If I invest for 1 year, obviously the annualized spot rate was 10.5%. So if I use the end mode function on your calculator, so don't change the settings, and I use n as 2, and I work out my annualized spot rate based on those 2 semi-annual payments, I'm going to get a future value of 110,775625. If I now invest for a period of 6 months in the 6-month zero coupon bond, then I need to determine what the current future value is going to be. So if I do that calculation, you'll see if I invest for 1 period and I have that 6-month coupon rate, that's going to give me a future value of 105.15. Right, so if we put all of that together, using the PV and the FV above, or just what we looked at now, and if I solve for the I, that's going to give me the actual annualized forward rate. In other words, what is that rate going to be in the next period? Right, so if you put in those values, if you put in the FV, and if you put in the PV, and you do a calculation, you're going to get 5.35%. Because this is a semi-annual period, okay, we've got every 6 months, we need to multiply that by 2 to get that annualized forward rate. So in this case, your annualized forward rate would be 10.7%. Right, so just remember that if you're using timelines, it's important because that can help with understanding. Right, so how do we summarize that in a very simple, easy calculation? Well, there is a formula that can help you calculate these forward rates. The forward rate equation is given on screen. Just remember to use that formula or to reference that formula when you've been given certain types of questions where you're looking at current rates and future rates and you're trying to identify what those should be. Right? You don't want mispricing in the market. Okay? You don't want arbitrage in the market. So whatever rates are going to be issued, you need to measure those rates and you need to determine what those rates are currently. And those rates will change and fluctuate from time to time. Right, so the example here, given the following information, you've got a 6-month maturity time frame for the first one with a period of 1, okay, T for N, which is the time period. Then you've got a spot rate of 3.5 and a spot current rate of 7. Okay, then you've also got a 12-month maturity bond with a period of 2, spot rate of 4.01, which gives you the current spot, which is 8.02. Right, so you can see obviously spot rate would be for these semi-annual coupons, okay, so half yearly coupons, right? And we're required to calculate the forward rate for the 6-month bond, okay, for the next 6 months, right, and the next 12 months, right? So all I have to do is literally plug in the values. Right, so it's basically your longer term rate over your shorter term rates. Right, so if I'm looking for the 6-month forward in 6 months' time, I'm going to be taking the later amount, the 12-month rate, which was at 4.01, and I'm going to be dividing that by the 3.5, and that's going to give me an answer. Right, and I would do the same thing if it was 12 months. I'd be taking the rates from the question, okay, and I'll be plugging those rates into the question to determine what the rates are going forward. Right, so please have a look at those calculations and see what you get. Right, you should be getting the 4.4725 and you should be getting the 11.56245%. Right, those are the 2 different rates that you have here. Okay, you have one rate for the 6-month forward in 6 months' time, and you have another rate for the 6-month forward in 12 months' time. Right, so I haven't seen too many questions about that in past papers, but it can come up. Those are measures that we need to know in terms of derivatives. Okay, this is actually a bit of derivatives. You'll learn a little bit more about call and put options. That is examinable, and that does come up a bit later on in this particular module. Right, so I hope that makes sense. Let's have a look at the next section, which is focusing on bond duration. This is a very important section. This always comes up in tests and exams. All right, so theory, bond valuation. involves calculating time value of money principles, where we're looking at some sort of yield to maturity, and we're looking at PV, which is the bond price. If we're changing focus now and we're taking those concepts a bit further, we're looking at bond duration. The word duration is looking at this concept of risk and how the term of the bond, the coupon of the bond, and the yield of the bond is going to affect how this bond will be affected by changes in what's happening in the market in terms of interest rates. Right, so how sensitive is this bond to changes in the interest rate in the market? Right, some bonds will react a lot when rates change in the market. Some bonds won't react as much when there are changes in the interest rates. Right, so if you think about what's happening currently in South Africa, I'm sure all of you have realized it. Currently, we've gone through a cycle of rising interest rates. In other words, the interest rates that are applicable to these loans, okay, or these bonds are increasing, they're rising. Right? And obviously, if those interest rates are rising, that's going to affect your bond price. Okay, we spoke about that in a previous on a previous slide. Okay, when rates rise, bond prices fall. When rates fall, bond prices rise. Right, so when you're looking at bond duration, just remember bond duration is just that. It's a measure of how sensitive a bond is in relation to changing interest rates. Right, sometimes you would want to invest in bonds that change a lot in terms of value when interest rates change, or sometimes you would want to invest in bonds that don't change as much. Right, so just remember, bond duration is a measure of risk, and it's basically used to measure and identify this concept, okay, the interest rate risk as well as the price sensitivity. Right, so long-term bonds are generally subject to more interest rate risk than short-term bonds, because think about it, over a longer period of time, more things can happen, okay, more changes can be made. The government can change certain rates, and we need to bring that into the calculation. Also, we need to consider low coupon bonds and how they differ from higher coupon bonds. Well, if it's a low coupon bond, they're subject to more interest rate changes. Then you've got the last section, which is looking at low yield bonds. Those are obviously subject to more interest rate risk than higher yield bonds. All right, so the calculation. How do we actually do a bond duration calculation? Well, it's actually quite simple. All you need to do is think about duration as a measure of the price sensitivity of a bond. In other words, how drastically will a bond price change in relation to the maturity of that bond and the sensitivity of that bond to changes in interest rates. All right, so there's different measures of duration. You get normal duration, you get Macaulay's duration, which is basically the sum of all your time period times the cash flow of your future cash flows discounted back in time to get the PV divided by the bond price. Right, just remember, it's just an adaptation. What different researchers and economists and even perhaps financial managers have done is they've tried to refine these different measures of duration in order to get a more accurate measure of duration. In other words, how will prices be affected when certain things happen in the market. Right, so you get Macaulay's, you also get modified duration. There's a formula there, just looking at Macaulay's duration divided by 1 plus the yield to maturity for all the coupon payments. All right, but yeah, that's just some background information regarding this section. You need this formula. All right, so effective duration, remember this formula, write it down, save it somewhere. Okay, the effective duration formula is numerator over denominator. In the numerator, you're going to be taking your bond price when there's a rate decrease minus the bond price when there's a rate increase. And then you will divide that by 2 times the initial observed price times the change in rate. Right, so let's have a look at a worked example just to explain what we're going to be doing here. Right, you can use Macaulay's duration to work out that price sensitivity of changes in interest rates and how that will affect certain companies. Right, so if I'm calculating the Macaulay duration, if I have a bond face value of 1,000 and I have time to maturity as 2 years, and there are coupon payments here of 60 every 6 months, and the yield to maturity is given as 7%, is it possible for us to calculate the bond price? Well, the easiest step I would suggest is to use your calculator, but insert the right values into your calculator and make sure you use the right I to discount future cash flows back in time. Right, so if I'm looking at Macaulay's duration, I've given you different steps here so you can see all the steps when you're going through these notes. When I'm looking at Macaulay's duration, I'm going to be focusing on the time period. That time period could be anything, right? Obviously, it'll be cash flows over a period of time, and then I'm going to be discounting those future cash flows back in time to determine the present value. Once I've got the present value, I can then compare the present value to those prices. Right, something else to also remember is the time period. Okay, in the last column, you need to take the time period and you need to multiply that by the present value divided by the price. Right, so if you complete all the steps, you're going to have an answer that's going to look like this. Right, so you can see I've taken all the future cash flows and I've discounted them back in time and I get an amount. Right, if I use that amount, that's a measure of duration. So if I'm relating that to Macaulay's duration, then I need to remember that I need to divide that by 2. Right, so duration is just a measure of how likely something is going to change in line with what you have currently in the scenario. Right, it is possible to modify that duration. If you take Macaulay's duration and you divide that by 1 plus the yield to maturity for the actual coupon payment, that's going to give you another measure of duration. In other words, how well is the investment going to react to changes in interest rates. Okay, remember, duration is basically a measure of changes in interest rates and how that will affect bond prices overall. Right, so you have an example here. Let's have a look at it. Given a 4-year bond paying annual coupons of 6% with a par value of 1,000, the spot rate is 7%. What is the effective duration for this type of bond when there is a 1% change in interest rates? Right, so the best approach here is to write down the formula. Right, the effective duration is basically a measure of a bond's sensitivity to a change in the interest rates. And the only way we can calculate that is by drawing up a table. Right, so draw up a table that looks like this. Maybe pause the video, take this down, and then continue with the actual video. First thing we need to do is put in the current situation. Right, so current situation is we have a par value bond, which is 1,000, okay, with a coupon of 6%, which is 6% of the 1,000. And then we've got an interest rate, which is 7%. That's the current situation. That's the spot rate. Okay, remember, spot is what's happening now. And then you've got N, which is the number of periods, and then you would be calculating or solving for your present value. Right, then we need to bring in the rate decrease. We need to show those amounts. So if I'm decreasing the rates by a certain percentage point, in this question they talked about 1%. Okay, so 1% divided by 2 would be half on the one side and half on the other side. Right, so when we're calculating those amounts, okay, we're going to be getting those prices. Okay, substitute the future value, substitute the payment and the N. And if I calculate the duration, I'm going to be needing those present value amounts in order to calculate the actual duration. Right, so you've got rate increase and rate decrease, and you've got all of those answers. Okay, you've got future value, payment, I and N. Okay, those were given to you. Your opportunity here is calculating what the actual present value is in line with the question. Right, so you get all of those prices. Okay, when there's a rate decrease, you've got the 982.87. For an initial rate, you've got the 966.13, and if there's a decrease, if there's an increase in the rate, then you'll get the 949.76. But you can see the higher the rate, the smaller the PV. Right, so take all of that information and calculate the effective duration. All you literally have to do is take those amounts that we just calculated from the table, insert those amounts into your calculator, and solve for the effective duration. Right, you should all get 1.71. That's basically giving you an indication of the level of change or what change could materialize or take place in the situation, and how likely or unlikely are those amounts going to be adjusted for or affected by in terms of the the workings in the question. All right, so putting this all together, it's simple. Okay, we just worked out the one. We need to calculate the change in bond price by taking effective duration into consideration, as well as the yield, right, the change in the yield. Right, so when we're looking at this particular question, I've got a given 4-year bond paying annual coupons of 6% per annum with a par value of 1,000. What effect will a 50 basis point change have in the yield available to this particular bond? Right, so most important, draw up a table and then solve. Okay, you've drawn up the table, you've got the amounts. Once you've got those amounts, you can insert that amount in as one of the measures that you have. All right, so if I'm looking at the present value of the bonds going forward, if I'm discounting all those bonds back in time, I've got amounts that I can then use to determine what the actual change in bond price is going to be. Right, so in order to do the calculation, you need to subtract or minus, okay, the effective duration, the amount, whatever it is, you need to make it negative, and then you'll divide that by the yield change. Okay, the yield change is that 50 basis points that we read in the question. And if you plug that into your calculator using the right equations, you're going to get an answer of 0.855%. Right, so what does that mean? Well, let's interpret. If I've read the question again, obviously you're looking at amounts that will be affected by a change in interest rates. Just remember, bonds are valued based on time value of money principles. If I'm taking future cash flows back in time, I need to know, well, what is that measure going to tell me about those types of businesses? Well, bond duration is looking at your ability to pay off your debt. Right, so if the yield, in other words, if the rate rises by 50 basis points, what is going to happen to the change in the bond price if that had to increase? Right, you can do this mathematically, or you can think about it logically. Right, you've done the workings already, so all you have to do is literally just take your amounts and adapt it to this question. Right, so if the yield is going to rise by 15 basis points, obviously if I'm increasing my interest rate, I'm going to decrease the price. Right, so you can see that the answer here is the price of the bond would decrease by that 0.855% if you round off to the nearest 3 decimal places. Or it could be 13 exactly, okay, because of the 855 as the change in bond price based on your current duration, the effective duration. All right, convexity, exactly the same. You've got a formula. That formula requires the bond price with the rate decrease plus the bond price with the rate increase minus 2 times the initial price, all divided by 2 times the initial price. Multiply that by the change in rate squared. Right, so you have another question here. 4-year bonds paying a 6% coupon, all right, with a value of 1,000, and the spot rate is 7%, which is your yield to maturity. If I plug in all of those values, I'm going to get those answers as my present value. Once you've done that, take those amounts and insert into the convexity calculation in order to calculate the right amounts. All right, so convexity is the bond price, which is the rate decrease, plus the bond price with the rate increase minus 2 times the initial price, divided by 2 times the initial observed price, multiplied by the change in rate squared. All right, so taking the information from question number 4, not question 4, sorry, the previous slide, for this 4-year bond, all you need to do now is plug in the values. Put in the bond price, rate decrease, put in the bond price, rate increase, put in the initial price, and then do the calculation. Just remember to use your numerator and your denominator and work carefully. If you do it correctly, you're going to get a convexity of 1.91. All right, so let's put all of this together. If I take duration and I take convexity and I put it together, I can determine a more accurate measure of the change in bond price based on these factors that will affect your investment decision. So if I'm combining total duration effect with convexity, that's going to give me the actual measure or the best measure of how a bond will react to changes in those two different areas. Right, so I need to take duration effect into consideration, and I need to take convexity as well. into consideration, right? And if I then do the calculation based on those measures we calculated earlier, and I combine those two measures together, if I take the duration effects and I add the convexity effect, taking the current change in bond price into consideration, if it was a 50 basis point change, which is what we have here, 0.5, how is that going to affect our bond price? Well, negative 0.3775%. Right, so let's interpret what we just calculated. Right, if the yield rises by that 50 basis points, 0.5%, what is going to happen to the price of the bond? Well, we would expect that bond price to increase. Remember, there's an inverse relationship between the increase in rates and the change in the price, which obviously will be inversely related, so a decrease. Right, so if the interest rates had to rise by 50 basis points, we would expect the bond price to decrease by that 0.377%. Right, it is possible to calculate the rand value, right, taking your current price into consideration. Right, and that takes us to the end of another set of notes looking specifically at fixed interest securities. Please remember to revise, go through the textbook, and try to do as many of the activities as possible from your study guide to help you prepare for your tests and exams.